Hey, and welcome to Technical Analysis of ETF Trends for RIAs with Brian Shannon, CMT, just like myself, from alphatrends.net. Awesome guy. Brian is the author of Maximum Trading Gains with Anchored VWAP. Excellent book. I've read it myself. That's actually why we have him here today. I thought this was an awesome book that we definitely need to talk about in the active community because that's what we're here for. So, all right, Brian, thanks for being here. Let's get to it.
All right, thank you, Ryan and Susan, and everyone at the NIAM, I guess is how you pronounce it. Today we're going to talk about strategies for ETFs, which I think a lot of RIAs are probably using for their asset allocation. I've always believed that risk management is job number one, and it's kind of, some people think it's geeky, but I have a favorite quote from Alan Greenspan because it makes so much sense. His job was risk manager of the economy is the way he liked to say it. Well, for us, it's risk management for our portfolios, for our clients' portfolios as an RIA. That is your job, I think. And, you know, people always say, well, it always ends badly. And it doesn't end badly if you have a plan, which is why active management is so important. I wasn't really familiar with what the objectives of an RIA were, and wanted to make sure that my presentation would be, you know, on target with this audience. And I was really happy to see, number one, to generate above average returns that exceed passive investing. I think it's all about timing. And second, there was risk management, which made my heart jump because I always say it, risk management is job number one. So anyways, I don't need to go through with you guys what an RIA does because you are the RIAs, but I'm pleased to see that this, I think, is on target with the goals of the NIAM Association. So let's talk about what we're going to cover here today. We're going to talk about market structure and different time frames. Myself personally, I identify as a swing trader in the market. For me, that means my typical trades are a couple days to maybe 3 or 4 weeks. That's my typical holding time. Now, obviously, with clients, you can't have that type of holding time. Maybe you do in a, you know, if you're running a hedge fund or something like that. But, you know, for ETFs and that sort of thing, I think you're probably trying to maximize the gains and get, you know, several months, several years types of trends. So it's all time frame dependent. And the great thing about technical analysis is that it's really not time frame dependent because of the fractal nature of the market, that what you learn on one time frame for technical analysis is just as applicable for other time frames. So keeping that in mind, we're going to explore market structure in that regard, based around the original work of Wyckoff and then Stan Weinstein, and then you know, using multiple time frames. And that's the strategy. The first book I wrote was called Technical Analysis Using Multiple Time Frames / How to Profit from Trend Alignment. And that's the strategy we're going to talk about, is trend alignment. Now, we have an hour here, so we can't get too deep into any particular subject, and it could take me days to really give you the education that I think you know, is capable. So we're doing kind of an overview here. But one thing that I'm passionate about is the anchored volume weighted average price, the anchored VWAP. And we'll talk about some strategies using that as well, realizing, of course, that we're just scratching the surface on all this. If you're still with me at the end of this, we've got a little bit of a quiz that we can do, and that's simply just looking at some charts together, and then you telling me what you think based on the way I'm looking at markets here and trying to teach you what you think about these different markets, where we are in the stages and that sort of thing. So everyone looks at the weather. I mean, you have to. If you're going out on a boat like Susan was today, you want to know what's the chance of rain. If the weather forecast says 100% chance of rain in the afternoon, you're probably not going to go out on your boat ride. That's just the way it goes. Now, maybe later you're going to see it didn't rain and everyone's going to complain, well, those weathermen never get it right. But the weather is about probabilities. It's so we can make a plan for what we're going to do. We can say, you know, listen, on you know, mostly sunny on Friday and Saturday on this chart, those are the days that we want to be outside. Thursday afternoon, probably not as much because there's a 40% chance of showers. It's no different in the market. We're trying to forecast some future event that we have no idea what it's actually going to be. So we have to look at it and say, what are the probabilities? What are the odds? And we use market structure to do that. So this is a simplified version of a market structure chart. And if you look at any asset out there, you're going to see these 4 stages repeated over and over again on all time frames. Doesn't matter if you're looking at a 1-minute chart or that is from today only, or if you're looking at the last decade using weekly bars or candles. This presentation I did with candlestick charts because they present better. My personal preference is for bar charts. It doesn't really matter what you use. There's whatever makes sense for you, and that's the key about all of this. Is that you don't take all of what I'm saying. I'm not expecting people to change what they're doing as an RIA and all of a sudden, now they've got this new way of running money, but instead to challenge you to think a little bit about technical analysis and how you might be able to get the odds in your favor a little bit better. Some basic things. I always talk about don't buy the dip, don't buy the dip. And we want to buy strength after the dip. We'll talk about what that means. So if we're, these are the 4 stages of a stock. Stage 1 is an accumulation stage. That's when the market is going sideways after a decline. So it takes time during that phase. Now for the markets, they go through the 4 stages. Sometimes a stock will get stuck in that stage 4, stage 1. Think of a stock like Zoom. It's still hitting new all-time lows here. So that stock hasn't undergone real accumulation yet. The markup phase, when stage 2 markup, that's when we want to be involved because it's bullish. That's when you want to buy strength after the pullbacks. You don't necessarily want to buy this pullback, let's say right here, because what if that high was 120 and this is 86? In hindsight, it looks like, well, you could have made money, but if you're buying it at 120 and then it hit 86, you're not really feeling too good about it. Well, it's at 86, and your clients are wondering, why did you get me involved in that stock? Instead, you want to buy strength as it starts to rally after those. As it starts to distribute, then you've got to say, is my money still best served here? Or am I going to start to, if you're a short seller, you're going to say, I'm going to start to look for short sales. I want to anticipate what's going on. And if it breaks down to a stage 4 decline when the sellers are in control, then I'm going to short. Now, I realize that most RIAs don't short, and that's fine. You can avoid this. You're doing a huge service to your clients by saying, we're just going to be out on the sidelines while the market goes down. And rather than having your $100,000 account draw down to $84,000, we're going to keep it at 100 grand. And then maybe we're going to buy it back over here. Let's say this was 86 and this is, let's say it drops to 24. Well, rather than holding it all the way down, you say, okay, we're going to buy it 42. We're still going to buy. Instead of having $50,000 to buy right in here, you've got your 100,000 plus whatever interest you've had. So it's all about time frame as well. But these stages repeat on every single time frame. So you can look at this chart and say, well, what stage are we in? We were previously in a stage 2 uptrend over here. And that's what I want to do is see if I can make that. I guess I can't make that smaller, which is kind of interesting. Anyway, so this is, this was a previous stage 2 uptrend, and the stage 2 uptrend then goes to a stage 3 distribution. And as it breaks a lower low below a flat to declining moving average, then we're in a confirmed stage 4 decline. As it starts to turn sideways and we're crossing back above that moving average or volume weighted average price, that's when we're in stage 1. This is stage 1 accumulation. And in stage 1 accumulation, we're going to anticipate. We're going to say, what gets me off the sidelines? Maybe it's a break of the higher high above that rising moving average, and then to set my stop. So I want to participate and manage risk. This chart happens to be a 30-minute, each one of these candles is 30 minutes, and it's about a week and a half, 2 weeks worth of data here, and this is a 5-day moving average. It could be 3 years. It could be the NASDAQ, from its peak over here to the decline just a year and a half ago. It could be the bonds. So here's a long-term chart of the bonds. So when we look at the TLT, The TLT is obviously getting a lot of attention now because the Fed is getting close to raising rates. And I'm going to turn this camera off because it's distracting. So let's see. I think I've turned that off. If not, sorry, but it just gets in the way of what I'm looking at on the screen here. So on the TLT, here we have a chart that began in 1999, and this is through the close yesterday, the 16th of July. And what we saw over here was we were making higher highs and higher lows above a longer term, in this case, 200-day moving average. As we cross below it, that gets us cautious. That's potential distribution. And then as it makes lower highs and lower lows, well, below that longer term moving average, well, then it's bearish. There's no reason to still own bonds in there. It starts to turn sideways when you say, okay, well, maybe it's getting ready for an advance. If it makes a higher high, I'm going to buy it, but I'm going to set my stop, because if you bought right here, that was the proper higher high to buy at. But guess what? Nothing works all the time in the market. Maybe the fundamental backdrop wasn't there at that time in late 2021. But what happened was we saw a breakdown, and you could have held at 155, or you could have cut your loss at, let's just say, 149. And if you didn't cut your loss at 149, you still might be averaging down and averaging down and averaging down and getting excited when it starts to turn sideways, only to see your heart ripped out once again. And then maybe it's getting ready to turn higher again. We're in this neutral period. So this is potentially stage one. If it breaks above these recent highs in here, to me, it looks like a stage 2 uptrend, and it's time to participate in bonds, that the bond prices are going to start to confirm what we've been hearing in the media, that perhaps the interest rates are getting ready to decline. The bond market is anticipating that a little bit, but they're not quite bullish yet. Getting above these recent highs, to me, makes it bullish, but I wouldn't just stay long. I would look at it and say, well, if I get long in here, where does my stop go? If my stop goes below the most recent relevant higher low, then, I just did have that there. I want to see if I can change the size of that pen. Anyways, that would be, maybe you buy it at 95.5 with your stop under this low. So your stop goes at 89. And nobody likes to lose 5-6%, but it's better to lose 5 or 6% up here than to continue to hold it and be down 40% or more and waste all that 3 years waiting for bonds to turn. So to me, that's the proper way to look at a longer term chart on a weekly time frame. Here's the NASDAQ, and this is what I was kind of talking about a couple slides ago with that 5-day moving average, this one right here. So look at this area right here and notice on this weekly time frame how similar it is to this area in here. So we had a strong advance in 2021, beautiful pattern of higher highs and higher lows above a rising moving average. And then we broke down. The pattern of higher lows was interrupted. That turns us cautious. And then as it rallies up to that moving average, gets trapped under it and makes a lower low, now it's bearish. It's guilty until proven innocent. To me, if you're going to be a buyer in here, you don't buy based on what you're looking at on the weekly time frame. Maybe you want to be a buyer on a shorter term time frame and make a trade in here, but get out before it continues lower and makes that next lower low. As the market turns sideways once again, well, right in here, it's time to start looking at the market. We've got a flat to rising 200-day moving average. At this point, it makes a higher high. It's in an uptrend. And guess what? Since that uptrend really began, and I'm going to say it began in April 23. You might look at a chart and say, well, that was, it began to rally here. You might get stuck thinking, the rally began right here as well. But the point is, none of us knows when we have a low. So we look to get involved as the momentum shifts. The longer term time frame, the buyers are in control, and we set our stop underneath the most recent relevant higher low. Well, we saw on this weekly time frame higher highs and higher lows. So even through today, where we saw the market got hit, this pattern has not changed. This was through yesterday, and this is the way I look at it on a 30-minute time frame. Because again, I'm a swing trader, so it doesn't matter what time frame you look at. But If we're above a rising 5-day moving average in the intermediate term, making higher highs and higher lows, it's innocent until proven guilty. If we break that pattern of higher lows, it gets us cautious. And then as it turns sideways and makes a lower high and a lower low, well, now you're bearish. Doesn't mean you have to stay bearish, because right over here, we get back above that 5-day moving average. Then we make the higher high above it. Now we've got that next move. So you could say, well, if you got, if you went sideways, if you went to cash right here and you got back involved right there, what's the difference? You might have paid a couple dollars higher, in fact. And I would agree with that. But I would much rather be a buyer when the momentum has shifted than to be a buyer over here, let's say, and ride it all the way down from ride it down this 6-7%. To me, I feel like a fool down here, and I'm probably going to throw my stock away and wonder why I did such a bad job. Same thing. It starts to turn sideways, can't make a higher high. Cautious, be a buyer. And then it turned cautious over here just a couple days ago. Last week, it turned cautious in the NASDAQ. Well, today, what happened? We had, being in cash was a great place to be because we had a much bigger decline today. S&P 500, same story. We had the higher highs and higher lows above the rising 200-day moving average. We started to flirt with that. Caution, then it started making lower highs and lower lows. It was still below the declining 200-day moving average. Guilty till proven innocent. It pops up here and makes that higher high. A stop would go under here. Probably weren't feeling too good about the purchase right here, but technically it gave no reason to be a seller. It still made that higher low. It broke below the 200-day moving average, but the 200-day moving average is still advancing. I always say it's the direction of the moving average that's more important than one or two closes below it. So through yesterday, we had a beautiful uptrend in the S&P 500, and to see a pullback even down towards 530, let's say, wouldn't be out of the ordinary. It wouldn't be a bad thing. People try to call for tops all the time in these things. So here's the S&P 500 on the 30-minute time frame, which was looking good through yesterday. Today we're down at about this level. Now, the reason we look at technical analysis, because we look at the charts and say, this is what people are doing with their money. If you don't understand the way that the market moves, the money moves in and out of the market, you're going to be a victim to your emotions. And your emotions are, here again, this is stage 2, stage 3, stage 4. If they don't scare you out, they'll wear you out down in here. And this is a weekly chart actually that I made a while ago of Cisco back in 2000. So this stock still hasn't recovered from there. But the point is, once it starts to decline, people start to become complacent. It's just some profit taking. And then as it makes that lower low, well, maybe I shouldn't be on margin. I'm going to sell a little bit. And then you start looking at news stories. You start, looking for news. Why is this stock down? The CEO said this or the CEO said that. I'm looking at their earnings report and, their earnings have been great. Well, the market's a discounting mechanism. It discounts what we already know and it starts to look forward. If you were to look at a chart of so many charts, but I'm thinking of Zoom right now because I mentioned it and I was just talking about it with Ryan and Susan that we're doing this on GoToWebinar. When Zoom was supposed to be the savior and Zoom looked like this. Now it looks like this right here. This is where Zoom is. Does that mean I think it's made a low? Definitely not. I don't want to be a buyer here. If I catch the low, it was complete guesswork. I want to be a buyer over here. Because in this case, this is a weekly chart. This is about, you can't see the time scale, but this is about 6 months, 9 months in between there. I don't want to waste my time with the stock going sideways. I want to get involved when the buyers are back in control. And we're starting to see that it's now in a better place to make money. So that brings us to the same story we started with, which is, well, what time frame is this? This happens to be a weekly time frame for about 3 years for Cisco. It could be, if you're a day trader trading S&P 500 futures, this could be one day. This is 9:30 a.m. This is 4 p.m. Eastern. Let's say SPY because obviously the futures trade longer than that. But this could be the SPY in your day trading. You've got a beautiful rally in the morning. You say I'm going to add to my winner, oh, what's going on? You start to deny, panic, capitulate, and now you've got a loser. And then maybe later in the day, it starts to rally again. So it comes down to time frame. What is your time frame? I know that my time frame is a swing trader, but I'm not going to buy or sell based solely on what I see for one time frame. It's all about trend alignment, which I said the first book I wrote was Technical Analysis Using Multiple Time Frames, How to Profit from Trend Alignment. And it comes down to Dow theory, really. Dow theory, in the 1920s, Charles Dow came up with Dow theory, and in the way he defined it back then is there's three different types of price trends: the primary, the secondary, and the short-term trends. The way he defined a long-term trend is those that can last for a year. You might find those on a weekly time frame. The secondary movements that might last for a couple months, a couple weeks to 3 months or so, that could be the S&P 500 daily chart. And for a short-term trade, a 30-minute time frame. So we've got a beautiful uptrend here. This yellow part is simply all of this area highlighted. This yellow part is this area right in here on a shorter term time frame. And you can see while we have a pattern of higher highs and higher lows here, we don't see, if we were buying this dip at this point, we're down a whole bunch right there. That's 129. Here we are at 122. Why not wait for it to do this and then buy as it emerges from that strength, rather than trying to blindly guess what the low is? So this is the full market structure. And this is a poster I put together a number of years ago. I think I made it in 2008 originally. And what it simply shows is it takes those 4 stages. And by the way, write this down right in here, or copy that URL, because you can get a high resolution picture of this chart right here where you can read everything. So I've taken it, I've said, these are some of the characteristics of a stage 1 stock, that then we break it down to sub stages, and these are the characteristics of it in there. What this chart further does is it says, okay, here's, let's just say, a weekly time frame, and maybe this is the daily time frame, and we're just taking this section, which might have taken 2 months to form, and we're blowing it up in here. And we've got to realize that even during that rally, the higher highs and higher lows, there were pullback periods. And I want to avoid those pullbacks, but in that A, that's where I want to anticipate and participate right here, and use these different time frames together over and over again so that we have that trend alignment. So the way we look at it is we look at a longer term time frame. And this is, for me as a swing trader, I look at a daily time frame. That's what I consider to be the long-term chart. Now, for an RIA putting money away for people's futures, you might look at that weekly chart as, found on the monthly time frame that goes back 10 years. Or maybe you're looking at a weekly time frame for your longer term. And the way I view the longer term time frame is, this is where I'm shopping. This is where I'm starting to look to see what's the primary trend. If it's in a downtrend and I'm a long biased trader, well, I'm just going to avoid the bonds until they at least turn sideways. And if they start to turn sideways on that weekly time frame, well, then what am I going to do? I'm going to look at the intermediate term time frame. Now, for me, again, that's a 65-minute chart or a 30-minute chart. But for an investor, I don't know why it's doing that. For an investor, I think that would be your daily time frame. So, you would be looking at the daily time frame that goes back maybe the last year and a half. And your short-term time frame might be the 65-minute or the 30-minute time frame to fine-tune your entry. But we want them lined up all in a row, all of our ducks in a row. That's the way we want them to be, so that we have that alignment of trend. Let's take a look now at the NASDAQ, and this is through midday today. This is the NASDAQ, the Qs, and here's the weekly time frame. So this is where our uptrend began, as we previously discussed. Now, what I put on here as well is this thick blue line. That's the anchored volume weighted average price from that prior peak. It tells us the average price since that peak. So from that average price, notice how the sellers showed up right at that. And then there was a little battleground there, and then the buyers took control. What we're going to focus on here, however, I'm just kind of putting your thoughts ahead to about 10 slides ahead. when we're going to discuss the anchored VWAP, about 5 or 6 slides ahead, I think. Anyway, so for a weekly time frame, we know that we're in a long-term uptrend right now. That upturn arguably began in, let's just call it March of 2023. So here we are in July of 2024. We've got this market up 16 months now. We've had 3 large thrusts higher. And does it make sense on a long-term chart to be a buyer up in these areas after it's expended all this energy? Or instead, are you looking at the current pullback and saying, hey, you know what? If it pulls back down in here, starts to turn sideways, and then starts going higher again, then I can get involved with a stop underneath that prior low. So if I'm a buyer as it emerges out of this decline, the short-term decline right in here, I set my stop underneath these higher lows. So that's our longer-term time frame. Then we look at the daily time frame, and on here I've got a 50 and a 200-day moving average. So this was our caution zone over here, and that should be yellow as well. And this was where we started to turn higher. And then, I'm sorry, so this is actually this circled area here, that yellow is this zone right here. So what we're looking at, this blue box of weekly information, we're now looking at daily information here. So what we see is this end of this weekly rally is right here. This pullback right here, it's shaded yellow because we're still in a advancing above a 200-day moving average, but it's yellow because we're below a declining 50-day moving average. The buyers regain control over here. So what's wrong with buying here with a stop under there and participating in all this instead of buying it here and then down here your customers calling you up and bugging you and saying, why did we buy there? It's just so much less. To me, it's about less stress. I don't want to buy the first day that the market's down because it might have 5 more days and I can save 8% and do what the goals of an RIA or an IM are, is to actively manage rather than passively just sit through this stuff. Instead, if we can be in cash, wait for the evidence that the buyers are gaining control, that's beautiful. On the daily time frame here, we still have a pattern that looks very clear to me. We have this high and we have this low. We have this high and we have this low. We have this high, and so far we don't have a lower low. So we're still in an uptrend. This is just a pullback. So what do we want to do? We want to take a look at maybe a shorter term time frame. So now we're going to take that daily information and we're going to look at the end. This is the last 2 months or so. This is May of 24. We emerged out of a pullback, and this has been this uptrend right here. We're still above the 50-day moving average. We closed at 481.77, so about $1.50 lower than this. So we closed at about right here, or right here on the shorter term time frame. So when we look at these cues, we see the bigger pattern is still uninterrupted. But when we look at this boxed in area that began right here at about 470, that's right here. That's this gap right here at this point. That's this candle right here. That's what we're looking at. And we were in an uptrend. But this area in here is where we went sideways a little bit. We didn't make a higher high until right here. So that was where you could have put short-term money to work. And then as it starts to turn sideways, it's up to you to say, okay, if it breaks below there, we're going to set our stop and get out. And unfortunately, it gapped lower. But if it's below, we're fighting that 5-day moving average on the 30-minute time frame. It says to me, be cautious. I don't want to be a buyer. I want to be in cash. This is the way I look at the market. Now it's in a pullback here on the short-term time frame. Longer term, daily time frame, longer term, weekly time frame, still in huge uptrends. But I don't want to be a buyer during this uncertainty. Maybe it pulls back all the way to the 50-day moving average, down at 470. Why would I want to buy it up here at 480 if I can maybe buy it at 470? It doesn't make sense. So here's the 3 of those time frames together. We have over here stage 4 decline, stage 1 accumulation. This is where our daily chart starts right here, and that's this big rally that we see. We're in this giant uptrend on the weekly time frame. On the daily time frame, we're still in an uptrend. And on the shorter term time frame, though, we have that misalignment of trends where we were cautious yesterday and it's bearish now. Does it mean I want to sell short here? Personally, no, because I want a trend alignment. I don't want to sell short because the primary trend is higher. And I'm a firm believer that a trend once established is more likely to continue than reverse. I'll change my mind if the market starts to make a pattern of lower highs and lower lows below a declining 50 and 200-day moving average. Until we see that, I'm going to maintain a bullish bias on the longer term picture, but realize I'm not going to be a buyer while people are just throwing their stocks away. I don't believe that you buy when there's blood in the streets. You buy after the people have come in and mopped it up and it looks pretty again, and you don't have to deal with all the blood and all the guts. Let other people with bigger accounts do that. Let them create the bottom. Our job is to be patient. When it's in a stage one accumulation, that's when we start to anticipate. Anticipate what? Well, we anticipate where do we get involved in this stock. I don't know why it's doing that when I have this clicked. Underline, strike through. Anyway, it doesn't matter. The point is, when we're in a stage one accumulation, we're going to anticipate. That simply means we're planning our trade. This is when we plan our trade. We say, okay, if it gets back above that prior high, then I think I can set a stop below that most recent relevant high or low, so I'm going to get long. And then as it does make that higher high, that's when we have our price confirmation. That's when we participate. That's when it's game on. It says, okay, we waded through. We did the good job. We did the hard part of sitting on our hands and waiting for the selling to subside. We let the blood flow. We let the mop committee come up, get the bounty bags, everything. Now it looks good. Let's start the parade back up. And that's the way we want to look at it. That's when we participate. When things are good, let other people, like I said, do the dirty work. And once we're in the position, we don't let our guard down. We manage risk. Just like we started out with that look at the bonds, that the bonds right in here. Yes, our job is to participate right here. But our job, once we're in it and we do the easy part of buying, winners don't take care of themselves. You have to manage risk. And that winner might turn into a loser, but let it be a small loser, not a loser that you buy here and are still dealing with, 3 years later and down 45, 50% or whatever it is. That is passive management. That is not the goal of what you guys are trying to do on a daily basis. So this is the plan. And as I mentioned, risk management, that's job number one. And it's the second most important thing it says on my AI search of what the NIM does. So let's go back to the SPY. This is through midday today. The SPY still in a beautiful uptrend. We had that caution over here on the daily time frame as it broke below the 50-day moving average. Caution because it was below the 50-day moving average, but not bearish because it didn't do this. It didn't make a pattern of lower highs and lower lows below a flat to then declining 50-day moving average. If it did that and broke down, well, then our caution would have said, hey, we're still going to avoid this pullback. Instead, it says the blood's been cleaned up. The parade is back on. Let's get out our little bells and flags and wave them and raise our stop. And on the shorter term time frame over here is this part. As a shorter term time trader, I say caution. I don't know if it's going to get trapped under here and do something like this, but I'm prepared for it. I want to be a chicken. I want to be involved when the evidence says the buyers are back in control, the music is turned back on, the band is starting to warm up behind the scenes. I see them starting to march down the street. Let's get in front of this thing. And oh, wait a minute, something happened here. Let me sell first and ask questions later as a shorter term trader. That's the way I look at trend alignment. So when we add another piece other than simple moving averages, and I believe, by the way, simple moving average versus exponential moving average, it doesn't make a difference. There, if you want to look at a quicker, the argument is that the exponential moves quicker and therefore somehow gives you some advantage. Well, instead of using a 200-day moving average, why don't you just use a 192-day moving average? It'll do the same thing. The point isn't that moving averages are a reason to buy or sell. They're a reason to say, okay, it looks like maybe the trend could be turning in here. We're not in here just to simply buy or sell. And the same is true with the VWAP and the anchored VWAP. They are a level of interest to get us to say, let's start looking at this on a shorter term time frame. If that shorter term time frame is telling us we have broken and we've made a lower low on the shorter term time frame, well, I don't want to be involved anymore. I want to wait this out. Same is true if we're at an anchored VWAP. It doesn't tell us buy. It says here's a level of interest that might be defended. So the volume weighted average price was started in 1988 as a study to say, are the buyers, big institutional buyers, getting a fair price for what they're paying when they hire Goldman Sachs to buy 500,000 shares of Microsoft back in the day? If they were buying 500,000 shares of Microsoft and the range was, I'm just going to make these prices up because I don't know what it was in 1988. The range was in 1988, it was probably like, $20 on the low and $22 on the high. And if they came back to you and said, listen, you got your 500,000 shares at 21.75, say, okay, well, whatever. I don't know how that fits. It seems like I should have gotten closer to the middle, maybe 21. Seems like I paid a lot. Why did I pay so much? When it might be that the most volume of the day did end up occurring at 21.80, let's say. So let's say the volume weighted average price for the day was 21.80, meaning on average, the average price that the stock traded at was 21.80. Well, if you got it at 21.75 on 500,000 shares, they did a good job for you. So it gave them a way to say, is my order being executed fairly? Am I getting a good price or not? If I'm not getting a good price consistently from this broker, I'm going to go use another broker. Well, it's evolved as an analysis tool. First, as the volume weighted average price, and the components are price, only price pays. It's how we keep score. The volume shows us the emotional level of commitment to that price movement. And then time, as we've said, is a relative study. The volume weighted average price takes all three of those and elegantly puts them on a chart. So what I have here is, this is just for example only, because I wanted to show you what VWAP itself is. VWAP itself is for one day. So it begins at 9:30 a.m. and it ends at 4 p.m. This line here shows us the average price adjusted for volume throughout the day. Let's say you had a 20-period moving average. A 20-period moving average might look like this on a 1-minute chart, whereas the average price was up here. The average price on this day was $3.90 for whatever this is we're looking at. So if you got filled on your sell order at $3.92, that means they did a great job for you. You can also look at it and say, I want to know from yesterday afternoon where the real buying began. Is that the level that this market is respecting? So you're saying that was an important event. I'm going to anchor to there. So anything other than the beginning of the day means you're anchoring. You choose where to set that anchor is what it's telling you. You could set an anchor right here if you were a quick in and out day trader and say, I want to short against that. Or if this was a monthly chart or the weekly chart of the NASDAQ, and maybe you're getting ready to look at it and say, that anchor, if it can rally up towards this level and if it can rally up towards this level, create a higher low and then get going, well then if these are weeks and this might have been 6 months of trading, well, this is where I want to get my clients involved because that's where the buyers are back in control. The reason we use VWAP and anchored VWAP is, one, it works. Two, Citadel Boss, CEO, founder, Ken Griffin, in 2023, he made $4.1 billion, more money than any hedge fund manager ever for any fund. When he was in front of Congress during the GameStop testimony, he told the Congress people, today virtually all trades executed by institutional investors are in the form of program trades. such as VWAP. Okay, this is his words in front of Congress. Well, if you take a further look at their website, like I did, then you saw that 35% of all the volume on listed volume is executed by Citadel. So they're saying we do 35% of all the volume in the market, and this is how we trade. You better pay attention. Ken went on to say the VWAP trades are executed over the course of a day, a week, or a month, meaning we can anchor it to the beginning of an earnings period, and it might take a month to execute that trade. But the institutions use this every single day. This is the main tool that the largest participant in the market uses, the richest person out there uses, and you better believe the other funds are using it as well. So why shouldn't we? Again, we'll go back to the S&P 500 from its peak in 2021, and we see that we briefly got back above the anchor from that peak, meaning the dip buyers in here started to make money, but did they hold on to it? And then as it rallied up to it this time, it got sold into. Then we saw a test, and then it broke through. It broke through there, and it broke through the 200-day moving average, but it got supported at the anchor from the prior high, meaning that the large institutions that were looking at this saying, well, as long as I have at least as good a price since that prior cycle high over here, then I'm going to be a buyer. This is a discount price in here. I want to be a large buyer. Well, then we look at that and we say, now how useful is this anchor? Is this helpful? No, not really. So we set another anchor from that low, which is hard to do with this trending tool. So, and it looks something like this. So you'll see that it acts as support along the way. So the way we look at it, all of this, cyclical analysis, moving averages, anchored VWAP, any tool that you use, if you find value in it, that's what you should use. If you find the MACD is your favorite indicator and it gives you the best ideas, that's what you should use. Don't ever let someone tell you that they've got something better. I would say though, if you use the anchored VWAP and just regular cyclical analysis, your results are most likely going to be a lot better. Your life will be lower risk and you'll make more money for your clients. Therefore, you'll make more money for yourself. Technical analysis, I don't use it as a system. I use it as a tool. It allows me to objectively say, what are the forces in the market telling me? Are they saying that the buyers are in control or the sellers are in control? The buyers are losing control maybe. I need to take a foot off the gas because we went to a short-term downtrend within a major uptrend. That's all it is. It helps us decide how much do we put in at certain phases. If this was our third drive up in the S&P 500 over the last 16 months, it's getting a little bit stretched. Maybe when I make my incremental buys after the dip, they're smaller pieces. Maybe I'm starting to sell into strength and look to replace what I sold, or so I replace half of what I sold at lower prices and gradually reducing my exposure to the market. Those are other ways of looking at, how to use technical analysis and do a better job for yourself and your clients. So these are the two books that I was talking about: Technical Analysis Using Multiple Timeframes, Understand Market Structure and Profit from Trend Alignments. I didn't even know what the title was. I thought it was How to Profit from Trend Alignment. My second book that I was printed in January of 23, Maximum Trading Gains with Anchored VWAP. It is a heavily, there's a lot of theory in there that talks about why it's important. And I debated on how much of that I should have kept in the book when I wrote it. And it's really odd that I got so much favorable response from people saying, hey, thanks for explaining it the way the institutions work and that sort of thing. I thought for sure people would just skip over that part and go straight into the strategies, where I lay out very specific strategies about how and when to buy, where to set your stop, how and when to take profits along the way. Either way, both of these books are available on Amazon. I encourage you to go take a look if you have an interest in either in more of this information. You can also find me at alphatrends.net and on Twitter or X, whatever you call it these days. I'm at Alpha Trends, and I like to say it because it's true. we've been here. You know, here's one I heard yesterday. And I had to look it up. I used AI for it. I said, my question to AI was, what are the implications of an inverted yield curve between the 2s and 10s? And it says, well, the 2-year bond yield is higher than the 10-year, and it's a recession indicator. It suggests that you know, we're pessimism, that the stock market impact. It says an inverted yield curve often spooks investors as it signals potential economic turbulence ahead. Anyways, someone tweeted yesterday, happy 2nd birthday of the inverted 2s and 10s. And how much, and so in other words, the 2s and 10s first went inverted right at the beginning of this move, right when the theory tells you that an inverted yield curve is bad for the stock market. So that's why I hold on to only price.